Many people refer to Bitcoin as digital gold, and in some ways, it's an apt comparison because of how unique Bitcoin is, and you have to try to connect it back to something that you can actually understand, which might be gold. But Bitcoin is so unique in certain aspects that once you begin to understand these specific little nuances, you understand that it is completely different than any other commodity like gold. And today I'm going to explain one of those aspects, which is the difficulty adjustment and the fixed issuance supply. These two things are directly connected, and there's a mechanism within Bitcoin that makes sure that the issuance stays relatively fixed until the max supply is hit, which is another aspect that's different, but we're not really going to get into that today. My name is Forrest Total. I'm a Bitcoin educator, and if you want to book me for a one-on-one coaching session, you can do so in the link in the description. We can go over Bitcoin best practices, security setups, and much, much more, and I can answer some of the questions that you might not even know to ask. So check out the link in the description to my website, pathtobitcoin.xyz, and let me guide you to Bitcoin mastery. In the past, we've had commodity money like gold and silver. That means that there's a real cost of production, and no one can just print more of it. No one can just arbitrarily change numbers in a digital ledger and create more units of currency. You would actually have to go out and source this commodity asset like gold or silver. Bitcoin operates in a very similar way. No one can just create more Bitcoin. If you try to, the Bitcoin network will reject it. If you fork it and change it in some way of giving you favor, it's not going to be compatible with the network that already exists. Or if you start it from a fresh network, block zero, those blocks that you mine from your Bitcoin 2.0 are not going to be compatible because they're not in the existing ledger that has the proof of work of the current network behind it. So you cannot copy and paste Bitcoin and create more of it, right? That's basically the double spending problem has been solved by the proof of work mechanism within Bitcoin. Without proof of work, the problem of double spending something digital was always going to be centrally controlled. It was going to be a central organization saying, this is the ledger, we have control of it. You cannot spend this because it's already been spent. You are now officially trying to double spend. So the proof of work, the network creates a decentralized organization that validates what coins have been spent and who owns what. Now, a lot of aspects of Bitcoin have been developed in a similar way to gold because gold works in a lot of ways as money. It doesn't work on a transactional layer as money, and it has many other vulnerabilities and issues that Bitcoin have solved for. But Bitcoin took certain aspects from gold. So gold is available around the world, right? And it was more easily available in history, right? It might have been closer to the surface. It might have taken less extraction, less refining. It was more easily available. And so as it becomes extracted from these gold deposits that are easy and close to the surface, it becomes harder and harder to get. Now, there's sort of the counterweight to that, which is gold extraction as a technology or as a technique becomes more advanced. So we now have, diggers and excavators and better supply chain mechanisms to efficiently refine it and scale and everything, right? So the technology is getting better, but gold is getting harder and harder to get. So nature has created a difficulty adjustment within gold. As deposits get depleted, you now have to dig deeper. You now have to explore further. Bitcoin has replicated this with something called the difficulty adjustment. And we're actually going to take a look at the mempool to visually see it a little bit better. So you can do this too. You can go to mempool.space to see a public block explorer. You're not going to want to put your addresses into this if you're really concerned about privacy. You'll want to run your own node and run your own instance of mempool on top of your Bitcoin node, and then you can look up addresses and it's just within your own network. So this tab right here is the difficulty adjustment. So this is a period of 2016 blocks, which is roughly around 2 weeks, because every block is supposed to be geared towards being released or found every 10 minutes. So you can see here that the difficulty adjustment is at a level in relation to the amount of hash rate currently on the network, that the blocks are being found faster than 10 minutes, right? It's 9.5 minutes. There's 30 seconds faster on average that the blocks are being found. So what this was showing is that in 5 days, when the full 2016 blocks are hit and found, the difficulty adjustment will adjust upwards. Essentially, it's going to take more guesses for your mining rig to hash the proper hash to be the one that found the block. If we go to the mining tab here and we check out this right here, this pink line is actually the difficulty. So you can see it goes up, it goes down, and this is all in relation just programmatically with the Bitcoin network. Are the blocks being found sooner than 10 minutes or longer than 10 minutes within this 2016 block period? And in the exact relation of how much faster it's being found, the difficulty will adjust for that. So if hash rate stays exactly the same in that same period, on average, it will take 10 minutes. But hash rate is going to fluctuate because as things become more difficult, right, as the difficulty adjusts upwards, there's going to be miners that are now no longer profitable. If the difficulty goes up, it becomes more difficult to mine. And so the inefficient miners have to go offline, or it costs them more money than they will make on average by contributing their hash power. So we can zoom out here. We can go to 3 years. We can see the difficulty on average is going up. The hash rate is going up in line with this. Now, this is programmatic. This is perfect. This has these slight delays of 2016 blocks where it allows for, increased block times or decreased block times, and then it adjusts to what that period's hash rate was, and it can go on from there. So on average, blocks are actually found sooner than 10 minutes, right? 10 minutes is what it aims for, but because the hash rate is going up and to the right, on average, the blocks are being found sooner than 10 minutes. And so it needs to adjust upwards constantly. On average, again, if we smooth this out, right, you can see these little drops of difficulty. You can see these stagnations or drops of hash rate, and it compensates and changes for that. Now with gold, this happens as well, as I explained, where gold deposits become more difficult to find. The gold mines run dry. The gold stops running in the river, what have you. It's been extracted out. So it becomes more difficult to find it. However, it is not perfect. Right? It is not a perfect programmatic supply issuance. So if we think about this for an instance, if we think about if gold's price skyrockets, what is that going to do but incentivize already operating gold miners to go and seek more gold, to double down on current production, to explore new mines, because now there's a greater profit incentive to do so. If you relate this to Bitcoin, if Bitcoin's price goes way up, it does the same thing to Bitcoin miners. Bitcoin miners are now way more profitable, and it incentivizes them to turn on more machines if they have them, to invest in more machines if they're able to get them fast enough. But they only have the 2016 blocks that they can affect. So say Bitcoin all of a sudden, for some reason, doubles in price. All of a sudden, I'm now buying a miner, my neighbor's buying a miner, we're all mining, we're all going to contribute a huge amount of hash rate. The hash rate is going to spike as well to a relative amount, right? It takes time to operate and to change these things, as it does with gold as well. And there's also the future prospect of, well, maybe this price isn't sustainable, so I don't want to invest too much infrastructure right away, because what if Bitcoin's price goes down? Well, there's also the fact that the difficulty adjustment is going to happen. So even with the price spiking like crazy, the hash rate spikes like crazy, and for that 2016 block period, Bitcoin might be mined faster, right? It might be every 9 minutes, every 8 minutes, because there's just so much hash rate coming online. But all that hash rate is being quantified by the Bitcoin network. And as soon as the difficulty adjustment happens, which would happen sooner than 2 weeks, right? So for this brief period, the supply issuance is faster. And as soon as the difficulty adjustment happens, as soon as the period of 2016 blocks are mined, the difficulty adjustment kicks in, and all that additional hash rate that was chasing Bitcoin mining as a profitable endeavor because of the increased price in the Bitcoin itself, all of that now gets equalized. The difficulty adjustment happens, and all of a sudden, Bitcoin blocks happen on average every 10 minutes based on that previous amount of hash rate that was contributed to the network. And now, because the difficulty's gone up so much, it's essentially very similar to the profitability that it was prior to the spike, right? And it's going to be relative. So there would still be a lag effect if the price spiked like immediately, as I said, if it doubled in price. There would still be a lag effect. It would still be profitable to put even more hash rate on. But after a couple of difficulty adjustments, or if it happens slower, right, the price fluctuates slower, then these things smooth out where on average, Bitcoin is going to be, between that 9 and 10 minute block time. So the difficulty adjustment is so programmatic, is so built into the system that it doesn't allow for large amounts of supply to be issued into the network, into the market, whereas that is not the case with any other commodity. So gold is the other best example. It's the one that I've been talking about, and it's because of its relative scarcity and its stock to flow. And I'm not talking about the stock to flow model and all of that. I'm talking about the existing stockpile of Bitcoin and the flow, the increased or the increase to that stockpile. So the production and refinement and extraction of gold, the increase in that stockpile. You can do it annually. You could do an annual flow, stock to flow. And that is roughly between 1% and 3%, depending. And we have no verifiable way of doing that, of understanding that. Bitcoin has something additionally called the halving, which reduces the stock to flow roughly every four years. So that gets programmatically halved every roughly 4 years. So the stock to flow of Bitcoin is actually about half as much as what gold is currently. And in April 2028, it's going to be a quarter of what gold issues every year, right? Percentage wise. So that's incredibly bullish, right? And supply and demand is so important to pricing, right? Of course, scarcity is only important if you have demand for it, right? There's some things in the world that are scarce, but they are not desirable. However, Bitcoin is not one of them. It is incredibly desirable. It is a asset that you can send to other people without permission, and it's a monetary asset that has no connection and control by any one entity. So if you want to hold an asset that isn't dictated, isn't dependent on other things like a government or a corporation, you want something like Bitcoin, right? And so in that way, again, it's similar to gold, right? So this comparison to Bitcoin and gold makes a lot of sense on a lot of fronts, but that nuance of the supply issuance being this fixed program and that it adjusts to the new supply, right? Because in every other industry, right, if all of a sudden there's a huge amount of demand for gold, the supply eventually will try to catch up, right? Your neighbor, right? Like how I talked about, like, I'm going to set up a miner, my neighbor's going to set up a miner. Same thing would happen for gold, right? So I'm now out in the woods prospecting with a shovel and a pick and my Levi's on, and my neighbor's out in the river panning for gold, right? So we're going to increase the supply. Now, it might be marginal because of the large stock of gold, but it's more noticeable on commodities like silver, right? Silver is less rare. It's more easy to affect the stock to flow ratio. Oil, it's much easier to affect the stock to flow ratio. And there's a lot of deposits of these commodities that are just not found based on the profitability. So it's not profitable to go prospect additional oil reserves or gold deposits or silver deposits when you don't need them, when there's no demand for them, when it doesn't make economic sense to do so. But as soon as these things go up in value, it starts making more economic sense to plan into the future to acquire these assets to be able to sell them into the market that has the demand for them. So Bitcoin, entirely different than any other commodity asset because of the programmed supply issuance and the difficulty adjustment. I think once you recognize how significant that is, how you cannot in any material way affect the amount of Bitcoin issuance by applying more hash rate, by applying more miners, and how any other commodity you can. When you recognize the significance of the difference between those two things, you recognize that Bitcoin is not only finite and different with the 21 million cap, but the supply onto the market is also fundamentally different than any other asset in the world. And that provides a huge amount of security in that knowledge of knowing how much Bitcoin is being released, 450 a day, right, at this current halving, and how much will happen tomorrow and the next day. That gives you a lot more information to rely on. That provides something that you can use as a denominator. We have no idea how much Canadian dollars, how much US dollars, how much gold, how much silver, how much oil is going to be created today or tomorrow. And we probably don't even have accurate representations of how much was created yesterday or the day before, right? Because there's so many complexities within every single one of those markets and so many unaccounted for extractions of commodities and creations of dollars. And it's just too much to calculate. With Bitcoin, it's all right here. I have a node that calculates it all, that has the audibility to be able to look at it and authenticate every single Bitcoin that's ever existed and know that with absolute certainty how much will be created tomorrow and the next day and the next day after that. And I can see that all the way into 2140, right? So that gives you something that is incredibly good at measuring other things. So we're far away currently in today's age from Bitcoin being the unit of account, but the way that Bitcoin is built, it will fundamentally be the best unit of account we have ever seen because of the programmed issuance and max supply. So hopefully that was interesting to you guys. I think once you begin to understand the supply issuance and the difficulty adjustment, you begin to understand, wow, how different Bitcoin is and the value proposition of Bitcoin. Thanks everybody for watching, and feel free to share this with a friend. Feel free to check out all the links in the description. I have one for Bitcoin Well, which is a non-custodial exchange. It's cream of the crop for exchanges. It's what I use. And if you sign up with my link, you'll actually get some free Bitcoin on sign up. Not much free Bitcoin going around, right? You can check out my website. There's a lot of resources on there. Again, you can book me for a one-on-one. There's links to hardware wallets, the cold card, which is what I use. You can check out the Start9 if you want to run your own node, 5% discount. Stampseed kit, 15% discount through the links in the description. Thanks everybody. We'll see you on the next episode of Bitcoin, Not Crypto.